So we've seen tech companies laying off their workers more than ever. It's reported that the industry increased its layoffs by 649% in 2022, which is the highest since the dot-com bubble. But as the economic indicators like the PCE and ATP suggested, the inflation is still strong and the labor market was not slowing down after the layoffs. That is even after the Fed set to raise the interest rate to about 5%. This is the first time since the financial crisis in 2008 that the Fed rate is expected to go this high. Well, it seems that it shrunk the price of most tech stocks, especially for those that are still counting on growth. For tech companies like FANG, or even chip makers like Nvidia and Qualcomm, have shown to either have a slowing growth or downward earnings in 2022. But if you look at the bigger picture, things are quite different. Despite the heavy layoffs in the tech industry, the overall labor market does not seem to have taken damage. The adjusted unemployment rate in January 2022 fell to a new low since January 2021 to just 3.4%. So even though we're seeing all the layoff news taking over the headlines, the overall employment is way stronger than what we see in the tech space. One reason is that tech companies do not have that much workers in the first place. The total number of the layoff workers is about 150,000 people. But at the same time, the total non-farm payroll employments rose over 500,000 in January alone. The main contribution came from leisure, hospitality, business services, and healthcare. So when compared to these numbers, tech layoffs doesn't seem to matter all that much. Just a few months ago, when the CPI was above 8%, people were betting on a recession. And yet, we've seen a 2 consecutive growth in the US GDP. If you look at the data, it looks like tech layoffs did not have much impact on the economy. Well, to think of it, the value of tech companies is really to just connect different sectors. Many of the services we need is already done a few years ago. Overextending on the subject is probably not going to help the product. Tech companies nowadays generally started from the 2000s dot-com bubble. At that time, the internet was still kind of a new thing to a lot of people, and that just made the companies that is involved in the subject somewhat techy. Then there goes the name tech companies. To me, I think it's better to call them web companies, because in today's standard, web tech is not something new. It's not like they don't really have any tech or something, it's just that their primary focus is their web services, and those are also where their main revenue come from, and that revenue is the problem. For most of the tech companies, ad services or commissions are the biggest part in their businesses. Platforms like YouTube, Facebook, Instagram have all integrated ads into their system. In the past few years, the revenue from the ad has skyrocketed. And those are the money taken straight from the sectors that are actually making the consumer product. I'm not saying ads are completely useless, as people would need a way to tell the others that they've got something to sell. I'm just saying that if the market push it too hard, it might hurt the advertisers' gain, and ads themselves do not really create much value, so at least I don't think they should be spending more in marketing rather than actually developing the product itself. But that is exactly the case today, especially when the interest rate is low. We saw a lot of products that are really not making any sense at the moment is still getting pushed quite hard to the market. There's even something like the FTX fraud that's going on. The reason why they just push out these random products is that they're really just trying to attract investors rather than consumers. And that's when there'll be like crazy amount of ads going on, with most of that money spent on the tech companies' platforms. In this case, tech companies are really just taking the profit that should have been to those that produce the product, which is really not helping the economy. At least not helping the production. And as the interest rate goes up, investors won't be so interested in new projects, and that would lead to a decline in ads. But that does not really mean the economy will go down, because most of the already profitable operations will still remain. What's better is that with the reduction of the marketing cost, more money and resources might just go back to the actual production, and that will help increase the total supply. So we might get away with easing the inflation with a lower interest rate. Apart from the problems on their revenue, there are also potential long-term demerits from the hiring strategy that these tech companies acquired. While the monopoly is serious in the consumer market, it is not so nice in the labor market either. They have the cash flow to provide the best offers in the market and can influence others to go for a tech job. This is also nice only when the market is growing. As their products getting more mature, the risk of a damage to their own market share caused by their own lineup is going higher. A split in the user base caused by a new product can open the chance to unwanted competitions from other rivals. And that's not the only downside. Making a product that is better than the ones that already exist in the market usually costs a lot of time. If anyone would want to make new products, they will have to ship it really quickly. And even if the company have actually made it, it could turn out to be a bad thing. There are anti-monopoly policies. Just look at how long it has taken for Microsoft to buy Activision Blizzard. Usually, if a company is already doing pretty well, the best thing it can do is to stay where it is, actively. That is why one of the reasons for tech companies to hire people is to get rid of the potential threat of the company. That means to hire the people who seem talented and not let them do anything. Well, this is understandable. It doesn't really help the economy when it comes to real cases. Letting those people out in the open and bring up new innovations might just be what we need right now. The pandemic have also contributed to some imaginations in terms of the future. Something like we might have to stay indoor most of the time. And that makes the tech companies going way more aggressive and hire way more people than they plan to do. I'm trying to say that there was a bubble in the tech space. The Nasdaq 100 index is performing way better than the S&P 500 and the Dow. What's more, even after the layoffs, they still have a significant increase in employees compared to 2019. But on the other hand, we know that they are not quite willing to push out new products. And just because the product is kind of slowing down, the revenue will also get a slower growth. And the thing that the tech stocks were most famous for is no longer appealing to the investors. They just favor companies that already have a stable cash flow. And when the tech companies are not so cherry anymore, they would try to go back to where they were. I mean, where they were last time the interest rate was as high as 5%. Well, it doesn't mean the product that we use would disappear. It just means that the companies might have to do a lot more conservatively. But all that stuff is only related to the tech space after all. I mean, we haven't really seen anything very useful that is pushed out by these tech companies after 2020. In this case, it might be better to just slow down and ease the marketing competition, and that might help us to set up a long-term growth.